Hi everyone, I'm Kathy Zip, Associate Editor of Wind Power Engineering and Development, and I'd like to welcome you to today's webinar, Community Wind, Financing Options in Capital Markets. Before we begin, I'd just like to go over a few house cleaning items. I'd like to mention that this webinar will be available after the presentation on windpowerengineering.com, and the webinar will also be emailed to all attendees. Secondly, there will be a question and answer session at the end of the presentation. We encourage you to participate. You may submit your questions at any time throughout the webinar by typing them into the GoToMeeting panel, and that's on your right. And lastly, we realize that not everyone who would have liked to attend this webinar could, so we encourage everyone to tweet about key topics and takeaways using the hashtag WindWebinar. So at this time, I'd like to introduce our presenters. Today we have Chris Diaz. He is Senior Vice President of Renewable Energy Finances at Seminole Financial Services. And we also have Brian Manish. He is President of Val Ad Service Corp. And CEO of South Dakota Wind Partners. So thank you both for being with us here today. And Chris is actually going to be our first presenter. Again, he is Senior Vice President for Seminole Financial Services, and that is a full-service national investment management and financial services organization. Chris is responsible for the identification, evaluation, and negotiation of renewable energy finance transactions, focusing on wind and solar projects that are in need of construction or interim financing. He's been involved with tax credits and financial services for over 15 years and holds a bachelor's degree in social science from Florida State University, as well as an MBA from Nova Southeastern University. Today, he is going to share some of the expertise with us. So Chris, go ahead whenever you're ready.
Great, thank you very much, Kathy. As Kathy said, my name is Chris Diaz, and I'm with a company called Seminole Financial Services, and we specialize in construction financing for renewable energy transactions, as well as a small amount of permanent debt for the renewable energy transactions. So thanks for attending the webinar, and feel free to ask questions via the mechanism there for GoToWebinar, and we'll try to answer any questions you might have. Let me get to the next slide here. So just for those of you that are not familiar with some of the terms that we'll be discussing today, I thought I'd just have a few terms to go over. One, distributed generation, which is electricity that's generated near or at the point of use. The grid, which I'm sure most of you are familiar with, but it has to do with how electricity is transmitted. Interconnection agreements are agreements that's a legal document to interconnect into the grid between the developer or the development entity and the utility. Net metering, which is an agreement with the local utility that allows you to reduce the electric bill based on the power that you produce versus the power that you use. Power purchase agreements are agreements to sell electricity from one party to another. Renewable energy certificates are a tradable certificate that represents 1 megawatt hour of renewable energy produced, and it's issued by a state specifically for that state. And then renewable portfolio standards are state requirements for utilities to purchase a certain amount of renewable energy. Next slide here. So types of wind systems, I like to give you a definition of what when you hear me speaking about what I'm talking about. For the purposes of this presentation, utility scale wind is 20 megawatts or greater. They're usually tied into the grid, and most of the time they're built by utilities or independent power producers. Then my definition for community wind is 1 megawatt to 20 megawatts. It could be either tied into the grid or into a customer's meter, and usually built by independent power producers. And then you have small wind, which is up to 1 megawatt. And these are typically tied into customers' meters or a net metering. This gives you a look at oh, let's go back one. There it is. Sorry about that. The different phases of a project. The first phase, as we look to develop these wind projects, is identifying the site, figuring out what technology you're going to use, working on your power purchase agreement. Is there a financial model that makes sense? That's what you want to identify in the first phase. Second phase is design and planning, where you're getting your wind study data, you're designing the system, you're arranging the financing and the permitting. Then the third phase is the installation, where you're physically building the wind farm or putting in the turbine or two that you're putting in. Then you have the fourth phase, which is completion and commissioning. And that's a key phase, especially from a timing perspective, getting in the queue for the utility, have them come out, make sure that they've tested it and everything works for the interconnection. Then the final phase is the operations and maintenance. So when we talk about wind project finance, there's just a couple basic components to that. The first component is construction or bridge financing. Second component is going to be permanent financing, which could come from either some type of market player or from a federal program. You have the federal tax credits, which includes the investment tax credit, the production tax credit, and new market tax credits. And then you have state programs where various states have loans, grants, specifically some states have energy credits, and then you have RECs that are produced from these projects. When we're talking about construction finance, I just wanted to give you some of the parameters. Typically where our company plays in the space of $2 million to $30 million, which is in that community wind space. We look for high quality developers, proven technologies with established track records. Sometimes the developer may not have a big track record or a long track record, and we put a lot of emphasis on the EPC and their experience in those instances. We look to see if there's a power purchase agreement negotiated, if there's an interconnection agreement that's negotiated or part of the power purchase agreement. We lend up to 90% of the loan to cost value, utilizing either the grant or some kind of syndication, which if you haven't safe harbored from last year, then you're going to be looking to do some kind of tax credit syndication this year. And there's a big push, I think, as we all realize, to get the production tax credit extended and to allow for the election of the investment tax credit if they do extend the production tax credit. And then the other component is where you are in the permanent debt. Has the debt been committed already, or are you utilizing some kind of state program? Wanted to give you some parameters of what we're seeing in the marketplace as far as terms for construction financing. Typically anywhere from 4 months to 24 months, but what I find it's usually 12 months or less. Interest rate anywhere as low as 6% and as high as 12%, and the median being somewhere between 9 and 10% on that. Typically there's 1 to 3 origination points. Financing of this nature is typically recourse, so you'll have either personal and or corporate guarantees, and the process can take anywhere from 4 to 8 weeks to get the construction financing funded. Permanent financing, and I always say in this space it's very difficult. $10 million and down is virtually non-existent on a consistent basis. There's some people that come into the market on occasion, but it's really, really hard to find. Most of the times I find people are working with regional banks or local banks to try to arrange some type of permanent financing. And the terms that I've seen when it is available, the loan term can be anywhere from 5 years to 20 years, the amortization anywhere from 10 years to 20 years, and kind of a rule of thumb from a lender's perspective regarding amortizing of the loan is they'll take the length of the PPA less 5 years, and that's about the longest most lenders are willing to go out. Interest rates range as low as 6%, as high as 10, and the points, anywhere from 1 to 3 points. And again, it's a 4 to 8 week process typically. So kind of where we are from a tax credit perspective, in the community wind space, I don't mention the production tax credit because it's really hard to make a production tax credit work for community wind and small wind. So typically the options are the investment tax credit, which are allowed to elect at least to the end of this year. And up to last year, at the end of the year, the grant was available. If you met safe harbor for the grant, then there's still people that are utilizing the grant. If not, people are looking for a traditional tax credit syndication model where they will have a syndicator come in and purchase the tax credits and the depreciation. Another credit that's available that's utilized for maybe the larger community wind transactions is the new market tax credit. This tax credit is specific to economic development areas or difficult to develop areas. It makes up approximately 20% of the capital structure, but there are a lot of restrictions on it. As I said, it can only be used in specific areas. And this new market tax credit, it can be quite expensive from a legal standpoint and a structuring standpoint, and fees from the people that have the new market credits that you're working with. State funding sources. Some states have tax credits. Some states have grants and or loan programs. And then some states, specifically states that have renewable portfolio standards, do have some type of renewable energy credits that are available. So all these help to make up the stack of your financing when you're looking to finance these transactions. And I wanted to just take a second to really focus on the RECs. It's a certificate issued by the state that proves that 1 megawatt hour of renewable energy was generated, and these can be traded within the state. And some of the common states that do have RECs are New Jersey, Massachusetts, Colorado, and California. So when we look to talk about the economics of a transaction, typically we're looking from a lender's perspective for some type of source and use. The source and use shows what the sources of funds are and what the uses of funds are, and it's helpful to have a breakout of the uses when you're dealing with a lender. So if you're sending them some numbers on your project, it's okay to show the turnkey cost for the turbine and the foundation and the tower, but we like to see a breakout of what your soft costs are, so any legal fees that you've accounted for in your numbers, any financing fees, what the interconnection costs are. Some of those costs are not eligible costs, so the lender likes to break that out to get a true picture of the project. From a pro forma standpoint, what are the cash flows? Typically, you have your power purchase agreement, and then some kind of, some states have some performance incentives, and you have state renewable energy certificates. Now, when a lender's looking at these projects, they will only underwrite to contracted cash flows. So when it comes to a power purchase agreement or the RECs, they're going to want to see a long-term contract in place. It's very difficult for a lender to allow a developer to utilize the spot market per se. From a programmatic standpoint, how are we looking at these construction and permanent debt? Construction time, pretty much 12 months or less, and then some type of 5-year to 20-year term debt. Interest rates, we kind of talked about the range. Most lenders are looking for a 75% plus or minus loan to value. When you get into probability factors, you're looking at debt service coverage at a P99 should be at a 1.0, and at a P50 it should be at a 1.40 debt service coverage. So as you model your numbers, you want to try to make sure that you're solving for these benchmarks. Some things that lenders look at when underwriting, one, as we just talked about, economic viability. What do the numbers look like? We talked earlier about the developer. Do they have a track record? Are they credit worthy? Sponsors, same thing. What kind of commitments have they made to the project? Are they committed, or are they just interested in it? And what's their track record like? The different contracts we want to have, if not fully negotiated, at least in a draft, agreed upon version, maybe ready to execute but not signed, your PPA and your lease, your interconnection, some type of EPC turnkey contract, and your O&M. Construction, things that really we see take time are the FAA approval, any air quality permits, or any kind of zoning or permitting that you might need. Those are all things that take time, and the sooner you get started on them, the sooner you'll get to a closing. From the wind data perspective, we're going to look at what's the wind study say. Typically, you're going to need at least a 1-year, if not a 2-year wind study, or some type of fairly certain extrapolation of wind data from a certain area. Technology, lenders are looking for what's called quote-unquote bankable technology, which is a technology that has a proven track record, a company that has a pretty solid balance sheet, a good warranty in place. There's ways to kind of, let's call it, maybe work around bankability issues. You might be able to get some type of reinsurance on the turbine or some type of production guarantee. Those are ways to help lenders get around any kind of bankability issues. We talked about the revenue streams already. Loan security, lenders are looking for assignments of the contract. So when you're putting your PPA and your leases together, you want to make sure that those can be assigned to the lender, that there's some type of ingress and egress easements that are available, that the lender can tie to some kind of title to the property, even though it's maybe a leasehold mortgage interest and not a purchase of the land. And then most lenders will look to have an ALTA survey. And finally, as far as O&M and asset management, looking for strong O&M companies that have good experience, the ability to get spare parts is also very important from a lender's perspective. So when we talked about a little bit about deed of trust and leasehold mortgage interest, and these all fall under kind of security or collateral that a lender's looking for. And typically, lender's going to want to be in a first security or lien position on the entire project. A construction lender is going to want to have the right to come in and complete and operate the project if something happens during construction. They're going to look for assignment and consents of agreements on the contracts, pledges of the managing member interests. A key one here is the subordination and non-disturbance agreement. So there might be, if you're doing a wind project and you're in an area that you are leasing the land and don't own the land, it's quite typical that there's a mortgage on that land. And in your lease, you'll account for a subordination and non-disturbance agreement, and that'll be worked out with the owner of the land. But a lot of times the owner of the land isn't thinking that you're going to need it from the underlying lender. So this is something that could take a prolonged period of time to get and take some education. So it's good to be proactive on some kind of SNDA from the underlying lender. And so I wanted to finish with a couple of examples of some creative community wind and distributed wind deals that we've worked on that have really set some new standards. This specific deal, Coastal Energy Wind, was a 6-megawatt wind deal in Grays Harbor, Washington, and they combined, it was the first time that someone combined the investment tax credit for wind and new market tax credits, and it was a real home run. This group, Coastal Community Action Plan, helps low-income families in this area, and this was a way for them to get away from reliance on annual funding from the state. And so far, this deal has done really well. It was a real unique combination of investment tax credit with the new market tax credit. This next deal is a good example of what I call distributed wind, where this group, Foundation Wind Power, put one GE turbine up at a large aggregating facility in California, and it's all behind the meter. So all the power that's produced is used there at the site. This next deal is a real unique deal, has a couple interesting components to it. This was a deal that we worked on in Lime, Oregon. They had 6 rebuilt Nordtank 500 wind turbines. It was a total of a 3-megawatt system. It's on Bureau of Land Management land. They utilized a REAP grant from USDA, utilized a 1603 grant that's allowed under the ITC, and then they got a loan from Oregon Department of Energy, their state energy loan program. So it was a real creative structure to finance a transaction. This was another deal that was a distributed wind deal done at an Anheuser-Busch bottling plant in California. Again, a one turbine behind the meter. They also, right next to the turbine, far enough away that there's no shadows on it, have a solar, a 1.5 megawatt solar field. So this particular bottling plant is really big on renewable energy, and it was a real home run for Anheuser-Busch. And so I guess you can go ahead and put your questions in online, and then after the next presentation, we'll go ahead and answer any questions that might come up. Thank you for your attention.
That's right. Feel free to enter your questions at any time. And thank you so much, Chris. Great information there. So now we will move on to Brian's presentation. Brian Minish has been a partner in Val Ad Service Corp since its formation in 2000. Prior to forming the company, he had broad-based agricultural business experience. Some of his background includes being a sales rep with Monsanto and securities brokerage prior to joining America Cyanamid in 1986. During his 13 years with Cyanamid, he held positions in logistics, sales management, and marketing management, including responsibility for the company's domestic insecticides. Val Ad Service provided leadership in the creation and funding of South Dakota Wind Partners, where Brian is currently the CEO. He has a Bachelor's of Science in Agribusiness and Animal Science from the University of Wisconsin-Platteville, and an MBA from Northwest Missouri State. So we're very happy to have Brian with us today. And Brian, whenever you're ready, go ahead.
Thank you, Kathy. Appreciate this opportunity to share the project that we undertook here in South Dakota a couple of years ago. Give you a little background, Val Ad Service Corporation. What we do is help startup companies go everything from a feasibility study to business plans to preparing the offering documents for either private placement or some sort of public offering. And we had a lot of experience doing this in the ethanol industry over the last 10 years. I did a lot of work for POET as they were establishing plants across the country. And we were asked a couple years ago to assist and see if we could find a method to copy what we did in the ethanol industry in the wind sector by having a large, broad base of investors participating in the investment in this case, in a South Dakota wind project. And so we undertook that project, and I'll give you a little bit of the background on the project. And probably the unique thing about it that you'll notice, especially after Chris's conversation, is that we did go with an unconventional financing method. We raised our funds through a public offering, and we also then had our investors do the financing, so we didn't go through the traditional and conventional financing model. Let me see if I got the... See if I can get this to work here. There we go. The project that we had originated from 4 different groups in the state of South Dakota that wanted to, again, give the opportunity for investors, much like the people who invested in the ethanol industry, an opportunity in wind. The groups were the East River Power, South Dakota Farmers Union, South Dakota Farm Bureau, and the South Dakota Corn Utilization Council. So they each provided a $20,000 grant for us to do the feasibility study and some of the startup capital to see how, if we thought we could find a structure utilizing the 1603 grant that would work. The size of the project, we do have 7 1.5 megawatt GE turbines. Total cost of about just under $24 million is what we estimated our cost to be. We had expected to use the tax grant, which again was, in this case, about $6.7 million. So we needed to raise about a little over $17 million in the scope of this project. One of the things that we did was went out and had some agreements. The project was initially a project that Prairie Winds, who was a subsidiary of Basin Electric, was putting up 100 turbines. And so we discussed with them and had an agreement with them that we would add 7 more turbines onto their wind farm as some other leases became available. And then also there was another turbine put up for a community college, so the whole wind farm ended up being 108 GE turbines. And so we worked to get these following agreements all put in place, which would then give us the basis for our business and give us the opportunity to develop our business plan based on these agreements. Just a quick overview of what these are. Construction agreement. Basically, the Prairie Winds as a company would go ahead and construct ours along with theirs, and we would then just pay them for the construction of our project. We would not participate in the transmission line. We would deliver our electricity to Prairie Winds on the wind farm site. That they would, they also then were connected to the distribution and to the WAPA system that was about 11 miles away. And what we did as far as our costs, we just paid a proportionate share of the cost for the entire wind farm. We paid 6.48%, which is 7 of 108 of the total cost for the construction of the wind farm. So cooperating with a large entity like this gave us the opportunity to have the efficiencies and size and scale of the large project. We also work in agreement with them that they will do the operations and maintenance on our 7 towers. Again, doing that as a proportional to their total costs. Again, 6.48%. We had put in the proper precautions for risk mitigation as far as having a insurance program that we put for casualty and business interruption, and then because we are paying a proportional share of the costs, even if we would happen to have one that was a lemon, we would still be only paying the 6.48% of the total cost of the 108 turbines, the cost for all of the O&M on them. And then we have a power purchase agreement with Basin through the Prairie Wind subsidiary for all the power we can produce up to 12 meg. Start out at a 4.37 kilowatt, and then it escalates 1.5%. And then at the end of 6.5 years, there's mutual option agreements put in place where we have the right to put to them the purchase of our 7 turbines, and they have the right to call it from us. So we did end up with a limited investment time period for our investors as they got into the project. So I'll give you a quick background. Some of the objectives we wanted to do in structuring the entity and our offering was that we were going to raise both the debt and the equity from the investors. So as I said, more of an unconventional financing method. We're planning to use a bank to finance our project. We're simply going to offer the debt opportunities to our investors, both as equity investors and also some debt. I'll explain how that worked. We wanted to go out and offer it primarily to the organization's members or other South Dakota investors the opportunity to invest. So we had basically two different investor targets. We had those that were looking for more of a fixed income, and then those that could utilize the tax benefits from the accelerated depreciation that would come from the project. So we wanted to also make sure we had a balanced debt-to-equity ratio when we were done, and obviously have the rewards be proportional to the risk so that we could attract capital. So what we elected to do was do a public offering, and this is probably a rather unique method of raising capital, at least in the wind world, as we've found out. It's something we had used a number of times in raising capital for some of the ethanol and other projects we've done over the last several years. What that means is that we can go out and offer this investment to the residents of any particular state, and in this case it was South Dakota. It does allow us to go out and promote it, invite people to meetings, have public relations efforts, things that create the interest and the buzz about the project, which is different than if you do a private placement type of an offering where you are restricted from doing those things. We also then do not have an accredited investor requirement like you do with a private placement. So we could basically self-define who we wanted to invest. We still are required to have disclosure in our prospectus, so there's a considerable portion of the prospectus that covers the risks that are involved in the project. And we needed to stay under 500 investors in any one class. This is a requirement, a federal requirement. If you go over 500 investors in the class, you become a public reporting company, which means that you have to do quarterly filings, very costly audits every quarter. So we did not want to do that, and so to avoid that, what you need to do is if you're going to have over 500 members, you have to have different classes of investment, and different is defined by the federal securities laws, and so we had to work within those requirements. Now, not all states do require public offerings. We are currently doing one in New York, which does allow this similar structure. I would say most states do, but we have run across states. I know Texas is one state, North Dakota is another that's got some restrictions on being able to do a public offering for a startup company. So what we structured were 3 different classes of units or shares. Units are the same as a share, but in an LLC. And each of these classes would require a purchase by the investor of some equity and some debt, and the debt would be a note. The notes would be for just 6 years, 9 months, so just under 7 years. And each of the different classes would have the same term of note, but the different classes ended up having different interest rates tied to them. And all of the debt is secured by the assets of the company, and the only bank financing we needed to have for the entire project was the interim financing during construction. We did have that done on the outside, and it only helped reassure us that we had done the right thing with the amount of paperwork and details that had to be done and the costs that we were incurred by just simply putting together about a 9-month note for the construction period. So it's one of the things that you do save in a structure like this, and probably the one thing that I would do different than we did, I would probably also have my construction financing for the note portion, as we did here, done by investors just like we did on the long-term financing. So we, again, each class had different rights associated with them. So they had different voting rights, different settlement rights, and at the time of the sale of the company. So those are some of the things that we made different. For example, on one class of shares, it was 1 vote per member. On other types of shares, it was 1 vote per share. Some of the things that you can make different to make sure that they're different enough that they're considered different classes. All of our equity units we valued at $750 a unit. Each class of equity units were entitled to the earnings of the company or the tax loss. So no matter which class it was, A, B, or C, they all had the same treatment from a sharing profits and the tax advantages. There was a limited amount available of each class. We didn't take over 450 to make sure we stayed under the 500 level, so we wouldn't become a public reporting company. So our Class A investment options looked like this. There was a minimum of $15,000 investment. 1 unit of equity was in that investment, so $750 was for ownership, and then they provided a note to the company for $14,250, in which we paid a 7% interest rate. Again, this group of investors entitled to 1 vote per person. They had a preferred status on any filed distribution. In other words, if for some reason you sold it, you came up short, these were the first people to get their money back. And they elect 1 of the 7 members of the board of managers for the project. Class B investment, very similar, except it was 2 units of equity that they'd invest, so 10% of their investment was for equity. The other 90% was for debt. On that debt, we paid 6 3/4% interest. They got 1 vote per unit rather than 1 vote per member. They became second in priority on a final distribution, and they elected 2 of the board members. And then our Class C investors were geared more toward the investors that were looking for the path of losses that could be taken or the tax advantages from the project. And so when they made a $15,000 investment, they got 19 units of equity, or $14,250 was equity, $750 was debt, which we paid 5.5% on. Again, they got 1 vote per unit. They had 3rd in line for any distributions, and they elected 4 of the 7 members of the board of managers. So by doing these different items in here, they made each of the classes different enough that we then could go over 500 total investors in the project, and we ended up with about 614. Our investments would have to be made in increments of 15,000, so somebody can invest 15, 30, 45, 60,000, et cetera. So we ended up with a very balanced debt to equity, as I said, was one of our objectives. If you look at the red in here being the portions that were debt of each of the different classes, and then we got the federal grant in for the 1603, which really all comes back in as equity. We ended up with a very balanced debt to equity ratio for the project at the end, and has worked nicely and met our objective there. Give you a little bit of history. We have been in operations now just over a year. We actually came in under budget on our construction costs, about $1.89 million under budget, so we actually returned a little over $1 million back to the equity investors in the project from excess cash. We were in our revenues, we were $181,000 over budget the first year. We had 1 month of 65% efficiency in April a year ago, our second full month of operations. Our O&M costs for the first year came in $97,000 under budget. We've paid back to the investors to date $864,000 in interest, and we received the tax grant for the $6.367 million last August, and just a few weeks ago we paid out our first profit distribution of just under $300,000 to the equity investors in the project. So this is an alternative way that works works very nicely for community projects, because it does give you the opportunity to spread out the ownership to a broader base of individuals in the community or in the state under this type of a structure. We are, as I mentioned, currently doing a project in Ithaca, New York, where we're using a PPM to raise money for the at-risk capital to get the rest of the development done. And then we plan to go out into that project with a interstate offering like this, probably sometime later this year, early next year, to raise the construction funding for the ownership of the project. And I know that's why I know New York state law allows for this type of structure as well. So anyway, we appreciate, if you have any questions, be glad to answer those. My contact information is here, and we're be glad to entertain any questions. And turn it back over to Kathy now.
All right, thank you so much, Brian. And now, I'm sure after all that information, the audience does have some questions, so we'll begin asking those. Remember, you can submit questions at any time, even as we go through this. It's not too late. So why don't we start with a question for Chris here. Chris, would you say that the production tax credit uncertainty has had less of an effect, or will have less of an effect on community wind more than compared to other sectors of the wind industry?
You know, the tax credit itself is necessary to develop the community wind. So by the production tax credit going away, you're going to lose the investment tax credit. So what I'm starting to see is, people are really, whatever they can get done here in the next, handful of months is what's going to happen for the rest of the year, because our kind of cutoff is if you can't get the turbines by October, then you're probably not going to be able to get it finished by the end of the year. So that's kind of been our benchmark for if we're going to finance deals going forward or not.
Okay. Brian, somebody was asking a question about your 6-year agreement with Basin. They were wondering why 6 years, and if you can expand on that a little more.
Well, a lot of that was for allow us to take advantage, two things: to take advantage of the tax credit that we got, the 1603 tax grant. You have to own it for 5 years to fully qualify for that. Plus, we had fully expected that we would have use of the accelerated depreciation, which you actually get to stretch out over 6 years. So this gives us long enough to utilize and take advantage of all of the tax benefits that were available, and still keep it at a reasonable length for investors to invest in, and didn't feel like they were tying their money up for too long. So it was kind of a balance of meeting those requirements, getting the tax benefits, all the tax benefits that were available, and still making it a short enough term that we could attract the capital.
Okay. Chris, or I suppose this could be for either of you, is the new market tax credit set to expire this year as well, in 2012?
The new market tax credit is allocated on an annual basis. I'm not sure what their appropriation is, but I know it's allocated on an annual basis.
Okay. Let's see. This question could be for either one of you as well. Out of all the projects you've looked at to help financing, how many actually make it to actually build the project, and where do they fall the most? Where do they run into trouble where they actually don't get the project built?
Well, I can jump in on that. So I would say probably we've been very fortunate. So about, call it 75% to 80% of the deals that we look at end up getting completed. The things that really stop some of the deals are NIMBY issues, so not in my backyard, where people will come out and really oppose because they can see the turbines from this area is blocking that view or this view. Permitting issues where there's height restrictions that weren't realized up front. Land issues where the soils, initial soils report wasn't sufficient, and it turned out that as you really started digging in, the soil couldn't support whatever type of foundation you were trying to use. Those are some of the things that start blowing up deals.
Yeah, I would just add in that the getting a PPA obviously is one of the things that's very critical to be able to make sure that these projects get secured. And just backing up a little bit on the NIMBY issues, one of the reasons that we look at doing more, offering community investment like we did with our projects and we are in the New York project, is a way to get around this NIMBY issue, because you're giving really everybody in the community an opportunity to invest and become an owner. And a lot of those issues go away when you find that there's a large amount of local investment going to be involved in the project.
Okay. this is for, I believe this question is for Chris. Yes. The first time, you said the one project you mentioned was the first time that the new market tax credit and the ITC were combined. Why doesn't that happen more often? I would think that everyone would just, take all the assistance they can get. Is it hard to use both of those?
It's a very difficult structure. It's difficult from a timing standpoint. It takes minimum, I think the soonest I've seen one of those close is 5 or 6 months. Typically, it probably takes about 9 to 12 months to get it closed, which is definitely a negative. The attorney's fees are extensive, so even though it makes up 20% of the capital structure, you might only net out, by the time all the fees and things are paid, close to 10 or less percent. And just some developers look at it from an opportunity cost standpoint. If they can get their deal done with the current structure, then they just keep going with whatever structure you have, get the deals done, move on to the next deal. Another limiting factor for the new market tax credit is it has to have some kind of job creation component to it, and it has to be there's only the new market credit can only be used in certain areas too. So it's and maybe I made it sound a little easier than it is, but it is a very difficult credit to use and a difficult structure to utilize to get finance.
Yeah, I just might follow up. We've looked to use that 3 or 4 times, and we've never been able to make it work because of all the different requirements that Chris just mentioned.
Yeah, sounds like a pretty complicated process. All right, and here is one last question. I think this could go to either one of you. Which states would you say it's easiest to build or to finance a community wind project in, and why?
Well,
go ahead, Chris.
Go ahead.
I was just going to say, we're limited to, we worked in about 4 or 5 states. What I can tell you is we've had the biggest problem in Texas because they don't allow a state interstate offering for a startup company, which is makes it very difficult to raise any kind of capital for startups. New York and South Dakota, Minnesota, Iowa are all fairly has pretty much the same type of requirements that I mentioned for South Dakota, and would allow for the kind of financing we did to be done fairly easily.
Chris, do you have anything to add to that?
Yeah, I don't know that I would, pick out a state and say one's easier than another one. I mean, it's like anything is what is the climate in the state? Is it a state that's in favor of renewable energy? Is there a renewable energy portfolio standard? They have incentives in the state. Those are things that we look to that all help. But if the deal makes sense, it doesn't matter where it is. If it pencils out from a numbers perspective, then we'll finance it.
Okay. All right. Well, I think that's been a good discussion, and it's all we really have time for today. So again, I would like to thank both of our presenters, Chris and Brian, for being here to share their expertise with us. And thank you to everyone in our audience as well for listening. I hope you enjoyed the presentation and learned something. And remember that Wind Power Engineering and Development will be doing webinars bi-monthly, so keep an eye out for more to come. Thanks so much, everyone.